Now, along the way to announcing that its economy grew at its fastest pace in a year, China let it be known that industrial production and investment spending are also way up. So why continue to pump stimulus money into the economy? And what's the outlook for commodities? Well, we've got an expert. We have Jing Ulrich. She's with us. She's JPMorgan's head of China equities and commodities. Jing, welcome to the program. Good to have you back again. Thank you for traveling all the way from Hong Kong to visit us. So what is going on with the Chinese government and the economic stimulus package? Do they need to keep spending more money?
They're planning to keep the stimulus program in place for at least another year. This is in terms of fiscal spending. As you remember, the 4 trillion yuan program was first announced in November of 2008. That program is set to go on for 2 years, so until November of 2010. So in terms of fiscal spending, a lot of projects have just been started. They can't stop midway, can they?
All right, so they're going to have to continue because, as you say, they've got to complete these things.
Absolutely. But in terms of monetary policy, sometime in the first half of 2010, there could be some selected tightening, perhaps by raising the reserve requirement ratio for banks. Also, in terms of mortgages, we may see some tightening of rules in terms of lending to people who are buying second homes and third homes. But overall, monetary policy and fiscal policy will remain quite accommodating.
So should we start to pay attention to the differences between large-scale infrastructure projects and consumer spending? Is there going to be a time when people look at consumers and say, maybe there's a bubble there?
Not yet. The Chinese consumer spending has been quite resilient throughout the financial crisis, and this is one of the key drivers for growth in the years to come and decades to come. If you think about the Chinese economy, the first phase of the transition has been completed. That is a transition from export dependency to domestically driven growth.
Really, it is really done.
Well, if you think about it, this year has been the worst year in terms of the global economy. Exports in China have slumped. Throughout the first 9 months of the year, exports went down by over 20%. But look at the GDP number, 8.9% for the third quarter. The second phase of the transition will be more challenging, but more important, and that is a transition away from dependency on investments towards more dependency on Chinese consumer spending as well as services. But this second phase of transition will take some time, perhaps 3 years or 5 years.
So, all right, let's talk about investors who maybe don't have that 3 to 5 year time horizon and have been investing in commodities as a proxy perhaps for all of the stimulus that the Chinese government has been pouring into the economy. Is that still a good way to allocate capital?
China's demand for resources, especially copper, gold, iron ore, and increasingly coal, is insatiable. So if you're an investor looking at the medium to long-term growth trajectory for China, you are very well positioned to buy into natural resources, which China lacks. If you think about so far this year, the world economy has been in recession, but Chinese imports of various raw materials basically surged to record levels across the board, from copper to iron ore, from coal to even aluminum.
So it seems as though the commodity play is still intact.
It is intact, but also think about countries that can supply China with natural resources: Australia, Brazil, and those countries' currencies.
All right. I want to thank you very much, Jing Ulrich, coming in from JPMorgan, the head of China equities and commodities. Thank you for your insight.
Thank you so much for having me.